If you clicked on this video, it means you're looking for answers. Maybe you're feeling the tension in the markets and wondering if a crash is coming. Or perhaps you've heard about the next big correction but don't know what to do. You want clear, actionable advice from someone who has mastered the game of investing through every market cycle. Warren Buffett. This video will give you exactly that. A detailed step-by-step guide on what Buffett did before the 2008 crash, what he's doing now, and most importantly, what you can do immediately to protect your wealth and position yourself to thrive when the next market correction hits. Let's start by affirming this. Your instincts are right. Markets are cyclical. They go through booms and busts, waves of optimism followed by periods of fear. And right now, many indicators point to a buildup of risk. But don't panic. The goal here isn't fear, it's preparation. And Warren Buffett is the undisputed master of preparation. Understanding market cycles and Buffett's approach. The stock market is often compared to a roller coaster, full of exhilarating highs and stomach-churning lows. But more than that, it's a reflection of human psychology. Cycles of greed and fear, optimism and pessimism. When everyone is optimistic, prices rise beyond reasonable levels. When fear takes over, prices crash and investors panic. Buffett's genius is in recognizing these cycles and patiently positioning himself to take advantage. He doesn't try to time the exact peak or bottom, because no one can consistently do that. But he prepares so he can act decisively when the environment shifts. One key insight Buffett has often shared is that investing is not about predicting the future perfectly, but about preparing for multiple scenarios. This mindset turns market crashes from moments of fear into opportunities to buy great assets at discounts. What Buffett did before the 2008 crash. Let's rewind to 2007. The economy was booming. Housing prices had skyrocketed for years. Banks were handing out mortgages to subprime borrowers with little verification. Complex financial products were flooding the market. Products so convoluted that even many Wall Street insiders didn't fully understand them. The world was euphoric. Most investors were riding the wave, convinced this prosperity would last forever. But Buffett saw the risks. He noticed excessive debt, inflated asset prices, and a fragile financial system dependent on shaky foundations. While others chased quick gains, Buffett quietly built a massive cash reserve. This is crucial. Buffett's cash pile wasn't a sign of fear. It was a sign of preparation. He was ready to pounce when prices dropped to reasonable levels. When the crisis struck in 2008, markets plummeted. Panic swept across the globe. Headlines screamed disaster. Many companies faced bankruptcy. Buffett acted decisively. He invested billions in struggling but fundamentally strong companies like Goldman Sachs and General Electric. His investments came with favorable terms, including preferred shares and high dividends. This move stabilized these companies and positioned Berkshire Hathaway to reap substantial profits when markets recovered. This approach shows Buffett's long-term thinking. He buys into companies that may be facing short-term problems, but have strong competitive advantages and management teams capable of navigating crises. What Buffett is doing now. Fast forward to today, and the parallels are striking. The market is again exuberant. Stocks trade at record highs. New technologies like artificial intelligence and blockchain dominate the headlines. Stories of crypto millionaires spread rapidly. Yet Buffett's Berkshire Hathaway is sitting on over $170 billion in cash, the largest cash reserve in its history. Why? Because Buffett is waiting for fear to return. His timeless advice remains: be fearful when others are greedy, and greedy when others are fearful. Right now, the crowd is greedy. Valuations are stretched. Optimism borders on complacency. Buffett's cash pile means he's ready to strike when prices become attractive again. But it's not just cash. Buffett is also focusing on businesses with sustainable competitive advantages and resilient cash flows. He knows these companies will survive downturns and thrive afterwards. What this means for you. 5 steps to prepare. You might not have Buffett's billions or decades of experience, but you can apply his timeless principles to safeguard your wealth. Here are 5 steps you must take immediately. Step 1. Build a cash reserve. Cash is king during market downturns. Why? Because having cash allows you to buy quality assets when prices fall sharply. If you're fully invested when a crash hits, you may have to sell at a loss or miss buying opportunities. Buffett holds massive cash not out of fear, but to have dry powder ready for opportunity. If you don't have an emergency fund or investment cash set aside, start building it now. Even saving a small percentage of your income consistently adds up. Imagine if you had cash ready in 2008 or during the dot-com crash. You could have bought stakes in some of the world's best companies at fractions of their current prices. Step 2. Create a watch list of quality companies. Buffett doesn't buy blindly. He researches deeply and maintains a watch list of companies he understands and trusts. Look for strong financial health, low debt, positive cash flow, durable competitive advantages, moats like brands, patents, or network effects, consistent profitability and trustworthy management. Start compiling a list now. When prices fall, you can act quickly and confidently. For example, Buffett's favorite company, Coca-Cola, has a strong brand moat and consistent earnings. Such companies weather downturns better than speculative startups. Another example is Apple, which Buffett invested in later but recognized for its ecosystem and loyal customers. Step 3. Avoid speculation. Buffett famously avoids investments he doesn't understand. Crypto, meme stocks, and flashy tech IPOs can seem exciting but are often speculative and volatile. If you can't explain why you own something in simple terms, reconsider it. Investing means owning parts of real businesses, not gambling on hype. During the dot-com bubble, many investors chased internet startups without profits or clear business models. Many lost everything when the bubble burst. Buffett's approach is different. He sticks to businesses that generate consistent cash flow and have clear, understandable models. Step 4. Practice contrarian thinking. Most investors buy when others are buying and sell when panic sets in. Buffett's edge is contrarian thinking. He buys when others fear and is cautious when others are greedy. Right now, with exuberance everywhere, it's time to be cautious. It's not easy. Human nature pushes us to follow the herd. But this mindset is essential for long-term success. Remember, the greatest gains often come after the greatest fear. Step 5. Cultivate patience and emotional discipline. This is the hardest part. Buffett's favorite holding period is forever. Many investors panic sell or chase hot trends because they let emotions drive decisions. You need emotional discipline. Stay calm during volatility, avoid impulsive moves, and focus on your long-term goals. Remember, patience beats impatience every time. This mindset has allowed Buffett to ride out every market crash, coming out stronger on the other side. Why Buffett's mindset is your greatest asset. The biggest threat to your investments isn't the market itself. It's your emotions. Fear leads to selling low. Greed leads to buying high. Buffett's secret weapon is emotional control. He remains calm in crisis and rational amid panic. This emotional strength is what separates great investors from average ones. It's easy to be rational when markets are calm, but true investors show their skill when chaos hits. Imagine this scenario. The market drops 30% in 6 months. News headlines scream disaster. Friends sell in panic. You're calm. You have cash. You pull out your watch list. You buy shares in strong companies at bargain prices. Months later, the market recovers. You're ahead. That's the Buffett way. How to think like Buffett. Buffett doesn't predict crashes. He prepares for them. Preparation beats prediction every time. You can do the same. Build cash reserves. Research strong companies. Control your emotions. Be patient. Bonus Buffett tips. If you want to go deeper, Here are 3 extra tips from Buffett. Read daily. Buffett reportedly spends 80% of his day reading. He believes knowledge compounds like money. The more you learn, the better your decisions. Make reading a daily habit. Stick to your circle of competence. Buffett invests only in businesses he deeply understands. Don't chase every fad or complicated investment. Focus on what you know. Focus on quality, not quantity. Buffett prefers concentrated investments in great companies over spreading yourself thin. Quality beats quantity. Final thoughts. The next market crash will come. You don't have to fear it. You must prepare. Follow Buffett's blueprint. Build cash. Make a watch list. Avoid hype. Think contrarian. Practice patience. Start today. Your future self will thank you. Investing is a marathon, not a sprint. Buffett's approach may seem simple, but it works. If you want to succeed, adopt it. Take a deep breath. Make your plan. Prepare to act. Because when the market crashes, your moment will arrive, and you'll be ready. Remember, investing isn't about chasing the latest trend or reacting to every headline. It's about preparation, discipline, and patience. The very qualities Warren Buffett embodies. The market will always have ups and downs. Crashes aren't a matter of if, but when. The question is, will you be ready? By building your cash reserve, creating a watch list of strong companies, avoiding speculation, thinking contrarian, and cultivating emotional discipline, you're putting yourself in the best position to not only survive the next crash, but to thrive when opportunity strikes. This isn't just theory. It's a proven approach used by one of the greatest investors of all time. The difference between fear and fortune lies in your mindset and your plan. So take what you've learned today, make a commitment to act, and stay patient. Because when the market turns, your moment to succeed will come. And when it does, you'll be ready.